be an exciting and rewarding way to make money in the stock market, but it also comes with risks. Stop loss is one of the most important tools to protect yourself in options trading. In this video, we'll explain stop losses, how to set them, and why they are so important in options trading. We'll also cover how they can help you manage risk and improve your trading strategy. Whether you're new to options trading or a seasoned trader, setting stop losses can make a huge difference in protecting your capital. But before we proceed, please like, share, and subscribe to my channel. Let's get started. What is a stop loss in options trading? A stop loss is an order you place with your broker to automatically sell a stock or option when it hits a specific price. This tool helps limit losses if the market moves against your position. For example, if you buy an option for $5 and set a stop loss at $4, the option will automatically sell if its price drops to $4, protecting you from further losses. Consider a daily life example. Think of stop loss as setting a budget cap for shopping. If you have a spending limit of $100 and prices suddenly surge, the cap ensures you don't exceed your budget. Similarly, a stop loss ensures you don't lose more than your pre-decided amount in trading. In options trading, where even small price changes in the underlying stock can cause large swings in option value, stop losses are especially important. A graph of a stop loss shows how the trade is automatically exited once the price crosses a set threshold. For instance, if an option starts at $5 and declines, the stop loss activates at $4, cutting further exposure. This strategy provides a safety net, allowing traders to manage risk effectively and stay within their financial comfort zone during volatile market conditions. Why stop losses are important in options trading. Options trading can be a fast-paced and unpredictable market. Prices can change quickly, and without a stop loss, you could end up losing more money than you intended. Here are some reasons why setting stop losses is essential. 1. Risk management. One of the main reasons traders use stop losses is to manage risk. Without a stop loss, you might hold onto an option in the hopes that it will bounce back, only to watch it lose even more value. A stop loss prevents this by automatically selling when your option hits a certain price, keeping your losses in check. 2. Emotional control. Trading can be emotional. It's easy to get caught up in the ups and downs of the market. A stop loss helps you remove emotions from the equation, allowing you to stick to a pre-planned risk management strategy. This can help you avoid making rash decisions during times of market volatility. 3. Minimize losses. In any form of trading, it's important to know when to cut your losses. Options can be especially risky because of their time sensitivity. A stop loss helps you minimize losses by setting a predetermined exit point before the option loses too much value. How to set stop losses in options trading. Setting a stop loss is relatively simple, but it requires a good understanding of your options and how they behave in the market. Here's how you can set a stop loss. 1. Determine your risk tolerance. Before setting a stop loss, you need to know how much loss you're willing to tolerate. This will depend on your overall trading strategy and your risk tolerance. A common rule of thumb is to risk no more than 2% of your capital on a single trade. For example, if you're trading with $10,000, you should set a stop loss that limits your loss to $200 or less. 2. Use technical analysis to find support levels. Technical analysis involves studying charts and market trends to identify patterns that can help predict future price movements. Support levels are price points, where an asset tends to find buying interest and can be a good place to set a stop loss. If an option's price falls below this support level, it could signal further decline, and it may be time to exit the trade. You can use various technical indicators such as moving averages, Bollinger Bands, or Relative Strength Index, RSI, to help identify support and resistance levels. These tools can help you make more informed decisions about where to set your stop loss. 3. Set your stop loss at a percentage below the current price. Another method is to set a stop loss at a fixed percentage below the current price of the option. For example, if you buy an option for $5, you might set a stop loss at 10% below the purchase price, meaning the stop loss would trigger if the option falls to $4.50. While this is a simple way to set a stop loss, it may not always be the most effective for volatile options, as they can fluctuate widely. It's a good idea to combine this approach with technical analysis to determine more precise stop loss points. 4. Consider using a trailing stop loss. A trailing stop loss is an advanced tool that adjusts as the price of the option increases. Instead of setting a fixed price, a trailing stop loss moves with the market. For example, if the option price rises to $6 and you set a trailing stop loss of 10%, the stop loss would be at $5.40. If the price rises to $7, the stop loss would adjust to $6.30. This helps you lock in profits while still protecting your downside. 5. Monitor your position. Even though stop losses are designed to automate your exits, it's important to continue monitoring your position. Markets can change rapidly, and sometimes a stop loss may not execute as expected due to market gaps or slippage. By staying alert, you can adjust your stop loss if necessary or exit the trade manually if the stop loss doesn't trigger as expected. Common mistakes to avoid when setting stop losses. While setting stop losses is an essential part of options trading, it's easy to make mistakes. Here are some common errors to avoid. 1. Setting stop losses too tight. If you set your stop loss too close to the current price, you might get stopped out of a trade too early, even if the option's price only experiences a small fluctuation. This is especially problematic in volatile markets where small movements are common. It's better to give your position a little more room to breathe. 2. Not adjusting stop losses as the market moves. Once you've set a stop loss, don't just forget about it. If the price of the option moves in your favor, consider adjusting your stop loss to lock in profits or reduce risk. Trailing stop losses can help with this, but it's still important to actively manage your stops. 3. Ignoring volatility. Options are particularly sensitive to volatility, and prices can fluctuate dramatically. When setting a stop loss, be mindful of the option's volatility. Avoid setting your stop loss at levels that are too close to the daily price swings. Why you should always use a stop loss in options trading. A stop loss is key to protecting your capital in options trading, limiting loose ends, and preventing emotional decisions. It works like a shopping budget. If your limit is $100, a stop loss automatically prevents you from spending more. Similarly, in trading, it ensures you don't lose more than you're comfortable with. When the price of an option hits your set level, the stop loss triggers a sale, cutting further losses. For example, if you set a stop loss at $4 for an option bought at $5, it sells automatically when the price hits $4. This clear exit strategy helps you manage risk and stay disciplined, ensuring you stick to your plan without relying on market luck. In conclusion, stop losses are an essential tool for managing risk in options trading. They help you limit potential losses, protect your capital, and remove emotions from your trading decisions. By setting stop losses based on your risk tolerance, technical analysis, and the volatility of the option, you can better navigate the unpredictable world of options trading. Remember, trading options can be exciting and rewarding, but it also comes with risks. Always use a stop loss to ensure you don't lose more than you're willing to risk. With proper risk management, you can improve your trading strategy and make more confident decisions. If you found this information helpful, don't forget to like, share, and subscribe to my channel for more tips and insights on trading and investing. Thanks for reading. By following the steps above, you can manage your risk and protect your trading capital. Remember, options trading involves significant risk, and stop losses are one of the best tools available to help you minimize those risks effectively. Stay disciplined, keep learning, and always stick to your strategy. Stick to your